So hi everyone. Today I'm gonna present our research, which is which essentially establishes a deeper understanding of AMMs from an option theoretic lens. So before we start, let's go through some basics. So automated market maker essentially has two players: liquidity providers and traders. Liquidity providers deposit two kinds of tokens. One of them can be considered as a risky asset. The other one can be considered as a stable asset. And then there are traders who essentially exchange one token for the other, given the condition that the reserves of each kind of tokens have to follow an invariant, and the function is denoted by f in this presentation. Now, as a consequence, what happens is, so in such an AMM uh, with an invariant function, the exchanges of each, the amount of each token is a function of the spot price of the risky asset, and therefore the LP's portfolio has a valuation which is also a function of the spot price. Now, another way to look at liquidity provision is, so we can think that when an LP provides liquidity, they are placing a continuous sell order above the spot price and continuous buy orders below the spot price. So this is another way to look at it, and this will be helpful at the later part of the presentation. So given these basics, now the next thing is loss versus rebalancing. And one way to look at it is, so suppose a liquidity provider wants to stay delta neutral. And in order to do that, it maintains a rebalancing portfolio, which consists of an inventory of the risky asset. And what it does is that when the price of the risky asset increases, it buys, the size of the inventory increases. And similarly, when the price reduces, it sells the risky asset on the side. So essentially, the inventory reduces. So although this keeps the liquidity LP delta neutral, however, the price on the AMM has slight lag compared to the execution price in the inventory. And due to this staleness of price on the AMM, the delta neutral LP will incur a loss, which will be in the form, which like a continuous loss, which gets bleed to the arbitrageurs who are essentially taking advantage by fixing the stale price on the AMM. And this continuous stream of income that is lost is the LVR. Now, mathematically, the instantaneous value of LVR is proportional to the double derivative or the gamma of the LP's portfolio valuation or the pool value, and it varies quadratically with the price volatility and the spot price. So given these basic concepts, let me try to motivate you about this talk. So the whole story begins with the following interesting observation. So suppose we want to find a liquidity profile such that it incurs a constant LVR. Now, if we want to solve for this equation, then there was this interesting observation which occurred by accident, that if you add an error term to the LVR term and then equate this to a constant, then this partial differential equation becomes that of an exotic option, which is known as continuous installment options. So let's try to see what exactly are these exotic options. So before we go to continuous installment options, just a quick overview. So options are financial contracts that give their holder the rights to buy or sell an underlying asset at a fixed price, known as strike price, until a deadline. American options can be exercised at any point before expiration, and European options can only be exercised only at the deadline. And once exercised, the option pays a hockey stick kind of payoff, as shown in the figure in black. And the present value of the option looks something like the red curve in the figure. Now, in order to understand continuous installment options, so the exotic option under consideration is perpetual American continuous installment. So let's go over the characteristics one by one. So the first thing is they are perpetual, which means they don't have any expiration date. And the second thing is the continuous installment part, which essentially says that the holder or the buyer of the option has to pay a constant funding rate in order to keep their option contract alive. Now, because of these two characteristics, these options have two interesting properties. The first property arises due to the perpetual nature of the option, which is the time invariant valuation. This means that the present value of the option will not change merely by passage of time. And the second property is that CI options with large funding fees they behave very much like short-dated fixed-term options. And similarly, CI options with small funding fees, they behave a lot like large long-term fixed-term options. And to understand like what do we mean by behave like, let's consider this figure. So when funding fee is very small, then the curve looks, the present value of the option looks like the curve in the red. So we can see that the present value is large while the curvature of the option is not that large. And as you increase the funding fee, the present value of the option, it goes from red to green to yellow. So the present value reduces in absolute terms, but the curvature or the gamma of the option increases. So this is essentially what happens with the duration of fixed term options, that as you reduce the duration, so a monthly option will look more or less like the red curve, and weekly like the green curve, and daily option like the yellow curve. So the gamma increases and the present value reduces. But here in CI options, this can be tuned using this one variable, which is funding fees. So essentially, this observation can be formalized as follows. So if we provide liquidity such that the profiles valuation, the liquidity profiles valuation matches that of a perpetual American CI option, then the LVR of the liquidity position approximately equals to the funding fee of the corresponding CI option. So here the key thing is that LVR of a liquidity position more or less equates to the funding fee of the corresponding CI option if we provide liquidity in a certain manner. But now the question is, can we generalize this result? Which means if I provide liquidity, if I provide arbitrary liquidity, then is there a relationship between LVR of that position with some kind of CI option portfolio? And the answer is indeed yes. And in order to reach there, what we'll try to do is we'll try to replicate an arbitrary liquidity position using a portfolio of CI options. And in order to reach there, we'll focus on two properties. The first one, as we discussed before, is that CI options with large funding fees, they behave like short-dated options, which means that as funding fee grows to infinity, then the present value of these options, they converge to hockey stick payoff, or in other words, the delta of these options, they converge to step function. Now, due to time invariance of these options and step delta like behavior when funding fee is very large, we can prove that an arbitrary liquidity position can be delta replicated using a unique portfolio of CI options. And this portfolio is static, which means that you don't need to change this portfolio over time, unlike fixed term options. And in order to get an intuition why this result holds, so we'll use the continuous buy orders and sell orders notion of liquidity provision. So here in the figure on the left, we have a liquidity profile where on the right you have continuous sell orders and below the spot price you have continuous buy orders. And then you can think that if you consider an infinitesimally small amount of order shown here in the red oval, then the valuation of this small order is essentially an inverted hockey stick payoff. So therefore, this small order, which is like the small liquidity position in this narrow price range, can be represented using a CI option with extremely high funding fee, and therefore the entire liquidity band can be replicated using a distribution of options with weight W, such that each of these options has funding fee converging to infinity. So the converse of this result is that any liquidity position can be delta hedged using a continuous strip of perpetual options that are distributed over a strike price, and this portfolio is unique for a given liquidity position. Now, the next thing is that, so once we take a liquidity position and then we create the corresponding delta replicating portfolio of CI options. Now, the next thing is we try to find the limit of the weighted funding fees of the option that is being sold, or the option with strike price equal to the spot price, shown here in the red oval. So this is essentially at the money option. So the result here is that the limit of the weighted funding fees of at the money option of the replicating portfolio is essentially same as the LVR of the liquidity position. Or in converse, we can say that liquidity providers are essentially perpetual CI option sellers, and ideally they should have received funding fees based on the kind of instrument they are selling, but they are not receiving this funding fees, and this missing funding fees is essentially the LVR of the LP. These are not very important, but right now we showed that a liquidity position can be replicated using a continuous strip of options, but this is only theoretical, it's not practical. And if you try to create a discrete strip of options instead of continuous, then there's like an error, and this error monotonically reduces as you increase funding fee, as well as if you reduce the spaces between strike prices, which is sort of intuitive. And the second thing is that if you want to predict an LVR, future LVR, using this option theoretic modeling of liquidity profile, liquidity position, then one problem is that you'll have to gather the implied volatility of these perpetual CI options. Now, there are some hacky ways to do that, which is, so given a perpetual CI option, you first find expected holding time by finding the exit time, and then once you have the expected holding time of these options, uh, you you infer the implied volatility using term structure of fixed term options. And just to give you some idea, so you can sort of imagine that when funding fee is extremely large, the holder of the option cannot sustain that funding fee for too long. It has to either exercise the option or drop it. And so therefore the expected holding time will be less when funding fee is extremely high, and vice versa when funding fee is low. But again, uh, this approach gives uh, it's not too precise, but it gives like within 10% error. Now, one interesting thing that I find particularly useful out of uh, this whole research is that so this this work essentially gives motivation for CI options market in DeFi. Why? Because there are like three reasons. The first one is that so we saw that CI options are clearly a better tool to delta hedge a liquidity position compared to fixed term options, mainly because fixed term options have time value decay, but CI options are time invariant, so it matches the flavor of liquidity provision. The second thing is that as we saw, uh, inferring implied volatility of these options using uh, term structure of fixed term options is less accurate than compared to a scenario where you actually have a market for CI options and then you can infer implied volatility from that market. And then the third thing is sort of interesting that so since we know that liquidity providers are essentially CI option sellers and they are not receiving funding fees, which they should have, maybe for those kind of investors, it's a superior investment uh, if instead of providing liquidity, uh, they sell CI options because the risk is the same, but the reward is fair. So to conclude this work, so there are essentially three results. The first one is that an arbitrary liquidity position can be delta hedged using a static portfolio of perpetual CI options. And then liquidity providers on AMM are essentially CI option sellers, and they should receive funding fees, but they are not receiving funding fees, and this missing funding fees is essentially the LVR of the position. So thank you.
Yeah, we have time for one or two questions.
Is there like a, so you mentioned that liquidity providers are missing the funding fees when compared to the CI options. Is there like a threshold for amount of volume in a given range where the swap fees would make up for the CI option funding fees and somewhat make the liquidity provision equivalent as the CI
Yeah.
option?
So if you think the question you asked is essentially what should be the volume and the fees, or maybe the optimal fees that should essentially bring LVR net fees to maybe positive for the LP, right? Now, this is more like it doesn't relate that so there are two things. One thing is like we haven't done the volume analysis, and the second thing is that this question maybe I think like to me it doesn't directly links to the option theoretic framework because it's essentially the like LVR versus optimal trading fees and volume. Yeah.
Okay.
Like it's a question on LVR versus trading fees and volume. Maybe option theoretic understanding might help to solve this.